Right. Well, so we've been thinking a lot about the trajectory of both this pandemic, the economy, and the impact on real estate. And the saying is what forecasts are like opinions, which are like, well, that other word, everyone has one. So take this for what it's worth. But we believe that there's a plausible case for what we're calling a truncated V curve in the economy. And it basically breaks down into three essential phases. There's a lot of information here. I'll touch on the highlights and you all can review this at your leisure. I think the first stage is that we need to have some confidence that we're seeing a flattening of the curve. And if you look at the history in China and other places, I think there's a plausible case to be made that we could see a flattening of the curve come late April or early May in the United States. So that allows for more quote unquote essential services to get back to work, some return to consumer confidence, and yet we're still expecting to see some pretty devastating impacts in terms of GDP growth and job losses. But if that, back to work begins to roll out, we would expect to see, GDP bounce back pretty significantly come the end of Q2 and into Q3, as it did in China. The impacts on real estate during this shutdown period is really going to depend on the segment. Obviously, with industrial faring fairly well and retail and hospitality faring quite poorly. We're seeing it now, and we expect until we have a line of sight to a flattening of the curve and a reopening of the U.S. economy and life as we know it, that transactions are going to continue to drop precipitously. Price certainty, valuations, price discovery is almost impossible in the current environment. There are no comps. The debt and capital markets are highly constrained. So in the second phase, we expect to see declining cases, right? So improved testing, more targeted quarantining, and this could, see more recovered cases than active new cases. And this is probably a 2 to 3 month period that maybe gets us to mid-June. And, when this happens, we see, the second half of 2020, there could be a fairly robust snapback. We still expect to see the net impact to GDP, be in negative territory. The real estate impacts in this reawakening. We think industrial snaps back to trend line, multifamily and office collections, which have been somewhere in the 90 to 95% range, at least in April. That may change in May, will begin to improve, maybe not pre-COVID-19, but getting back in line. We think that retail is still going to suffer and hotel will take quite some time to come back. The transaction activity will begin to increase. And, the valuations, we're going to have some line of sight to revised forecasts of revenue and expenses. We think the discount rates that were in place pre-COVID-19 will largely be intact, maybe some slight expansion. The debt markets will begin to open up again, particularly for higher quality projects and sponsors. And again, renewed interest in maybe somewhat modified active segments in real estate. Industrial continues to be the darling, if you will, in the near term, in the midterm. But thinking about data centers and single family rental, life sciences, an emphasis on healthy office buildings and multifamily might become the rage. And then in the final stage,
Charlie, I know you're going to finish real quick. Just for those of you that do have to drop off, I know we're bumping up against time real quick. A reminder that these slides and everything will be posted online. You'll be able to find them there. Charlie, I know you have 1 or 2 more slides, so we'll run a few more minutes just so we can finish. But just a reminder to everybody, you will have this available.
And again, this is assuming that we have more effective testing and treatment. But prior to, I've heard a lot of stories saying, well, we're not going to get back to business until we have a vaccine. I think that is a very much a downside scenario because that's 12 to 18 months away. So at the end of the day, when we think about these three stages of recovery, I think we're likely to see what we're calling a truncated V curve, right? So, you know, the yellow dotted line is probably the curve that we would have seen without federal stimulus intervention. And I think that has put somewhat of a floor on the downside scenario, and that you will have a relatively robust return to economic growth. Still, I think we're going to see GDP growth in the -5% to -6% range for 2020, but that will come back and we'll regain that in some 5 to 7% kind of growth as soon as 2021. So that's the view from today, and we'll continue to update this.
Thanks, Charlie. And thanks to everyone for listening. I know we ran a couple minutes long, but hoping that the information that you stuck around for was well worth it. And as we mentioned, this will all be posted online. You can find all of our COVID-19 information on the RCLCO website. Please visit us there. And of course, if you have any questions or if we can help in any way, don't hesitate to reach out to us or any of our consultants. We'd love to be a supporting resource for you. Stay well and take care. And we'll be back in touch next week, guys. Thank you.